Is the Fed striking the right balance? Hi, everyone. Welcome to the Market House. I'm Maggie Lake, and today I'm talking markets with Darius Dale, founder of 42 Macro. Hey, Darius, how are you?
I'm wonderful, Maggie. It's great to be here. Thanks for having me. Appreciate it.
So happy to have you on Fed Day. Hey, everybody joining us on Substack and YouTube. As always, put your questions, comments in the chat. We'll get to as many as we can. And you guys are fired up because we already have some great comments and questions, but Paul has the best one. He wins right now. You either pay attention or you pay the price. And that is a quote from Darius Dale himself.
I was going to say, that sounds very familiar.
I love it. So
let's do macro. Macro will do you.
Don't do macro. If you don't do macro, macro will do you.
Yep.
That's a good one. So let's actually just jump right into the Fed and tell me what you were paying attention to in that meeting, because we got the 25 basis points as expected. But what did you make of what you heard from Chair Jerome Powell in the presser?
I think my favorite part of the day was when Mike McKee asked him about the 2% inflation target and trying to, like, why they always keep moving the goalposts. And he basically gave the most lawyer response ever. It's like, well, that's just the process of how we do it. And I was like, okay, so you're not gonna plant a flag in the ground on this 2% inflation target, which to me was very important. I think it's a very clear tale that even amongst the members of the committee that are sort of philosophically wedded to the 2% inflation target, I think they're realizing now that the probability of them ever actually achieving that on any sort of investable time horizon or forecastable time horizon is low. And so if that's the case, then it ultimately means that the balance of the risks between the labor market, between their price stability mandate and their maximum employment mandate are now even more further along in the direction of the maximum employment mandate, because there seems to be more acute risk in the economy from a cyclical perspective regarding that.
Yeah, it is surprising. One of the things that, I mean, we kind of know that they've had a really hard time getting a handle on inflation, right? Is that also then just saying, like, we kind of give up, like we're we don't really understand the dynamics here, and we're not likely to get our head around it. So being married to a sort of number is maybe a little unrealistic right here.
Yeah, I think as investors, we have to come around to the fact that this is a Federal Reserve institution, just based on the current composition of the Board of Governors and the regional Fed bank presidents, that unless President Trump is successful at ousting Lisa Cook by February, which it seems like they're likely to be unlikely to do that, then we're just going to have to accept the fact that they're going to slowly move in the direction of absolving the markets from this 2% inflation target. They can't do it in jump condition fashion, because you're going to talk that will explode bond yields higher and ratchet up term premia via rising inflation risk premiums. And so that's not something that they want to implement. That's not something they want to do to the economy and asset markets. But over time, we have to realize that we're all frogs being boiled alive in a pot of monetary debasement and financial repression. And this is the ultimate end game, or there's no end game. It's just the ultimate destination. And so you have to work backwards from there as an investor in terms of what that ultimately means for asset markets.
I'm wearing green. This was not planned. So I am, like, literally representing the frog that is being boiled.
As am I. This is my frog.
I don't know. Like, we just psychologically know that, right? What did you, a lot of people pointing out that the Fed, a lot of the comments seem contradictory. I mean, at one point he said it's really hard to know what to do, I think. And everyone's like, okay, well, that's not helpful. One thing that was interesting is one dissent only. I think people thought we were getting at least three. Those who had dissented in the past would join. Now you have Mirren, who we know is gunning for lower rates. Were you surprised that there was as much unity as there seemed to be?
Yeah, I think the markets were surprised as well, right? If you thought that Waller and Bowman would have dissented as well in favor of a 50 basis point rate cut, catch down rate cut, if you will, much like what we saw last September. The fact that they did not do that, I think, was at the margins negative for the kind of the near term pricing for risk, because it ultimately means that the speed with which the Fed is likely to return the policy rate to a more neutral setting is sort of slower relative to what the market was hoping for and pricing in. Now, we did get the updated dot plot, and you can make the case that partially because of Steve Moran's the inclusion of his new dot, which is obviously way down there in the high twos, low three, I think it was in the high twos, that new dot, now it's dragging down the entire dot plot. And I think most investors see that and go, okay, we just dismissed that as a function of the political dynamic associated with that. But the reality is, in our view, and in a view of very important people who are now on the president's list for being interviewed for Fed chair, You think about Rick Reed or Mark Summerlin, David Malpass, Kevin Walsh. These are some very important people in global financial markets that have agreed, that have come around to our view that this is an institution that just needs to have a significantly lower policy rate and significantly more innovation and flexibility with its balance sheet to address some of the K-shaped ills in this economy.
I'm glad you brought up the K-shape because I think there is a sense. All right, let's face it, we're all going to be trying to game out what this interest rate path looks like now. And it's more live and in play, I think, because of the kind of mixed messages, the unity of the Fed, the fact they went 25, they're talking about balance of risk, but they're still talking about balance. I think there's a sense that if they ease more aggressively, it's because of the political pressure. Is there an economic argument for them? Do you see the economy playing out in a way where they would be forced to be a little bit more aggressive or at least continue this steady ratcheting down of rates? How do you see that playing out?
Yeah, well, there are several economic arguments for this, and we've been making them for over 2 years now. One of the arguments we've been making for almost 5 years, which is the equilibrium core PC inflation rate in this economy, at least according to the 42 macro and secular inflation model, is somewhere in the high twos, maybe low threes. If that's true, then trying to run monetary policy with an arbitrary 2% inflation target that the Fed got from a dead central banker in New Zealand from the Reserve Bank of New Zealand Act of 1989 is a stupid policy. No offense to anybody at the institution. It's just not a very credible policy. So that's one economic argument for much lower policy rates in terms of just accepting that this is an economy with different levels of inflation. And if you accept that, then you're talking about a Federal Reserve that has more space and scope to implement more dovish policy. Number two, we continue to operate with a very elevated level of refinancing risk in the credit markets, particularly in the mortgage-backed market, where many investors are kind of shut out from home ownership and from being able to move as a function of this historically elevated spread between mortgage rates and treasury bond yields. And so Federal Reserve that is essentially maintaining monetary policy that's too tight to fix that is essentially contributing to that. And this brings up my final point, which is we are in a fiscal dominance regime. We can bury our head in the sand, and as policymakers, they can bury their heads in the sand and ignore that. But the reality is, this is a treasury that is, if you look at the next 12-month marketable treasury debt supply on a kind of on a rolling basis, we're up in the 11, $12 trillion range now, up from like 3 to 4 trillion prior to the pandemic. So we are now gobbling up essentially almost 40% of global savings on a rolling 12-month forward basis, which is almost double relative to the long run mean of the time series. And so it's telling you that, hey, there's not enough capital left over for the low income, medium income consumers at the bottom of the K. There's not enough capital left over for millennials and Gen Z people trying to buy houses. And there's not enough capital left over for folks like myself to start and expand small businesses. And this is why we have so many distributional problems in the economy, because the Fed has a policy setting that is too tight, trying to produce an arbitrary 2% inflation target that has nothing to do with the 2025 economy and everything to do with what was happening in New Zealand in 1989.
Darius, I just underscore exclamation point. I think that's really important because you're talking about economic dynamics here. And that's much more important, I think, not to dismiss the political pressure, but I think there's so much of a connection on Trump beating Powell's brow and that being the only thing happening here. In effort to address those conditions that you just talked about, I think is incredibly important. It really resonates with a lot of people who are going to be listening to this who fall into those groups. Small business owner like yourself, me, someone else on the team, new homeowner struggling to get there. So I think it's really, really important. It also really sort of resonates with a conversation that I just had with Juliette de Klerk for macro sessions, where we were talking about the labor market, and she was really honing in on this issue of youth employment, which she thinks has been grossly overlooked by both policymakers and the market. Let's have a listen to what she said.
So even if overall unemployment in the US is still 4.3%, you've had over the past 2 years, basically under 25-year-old unemployment going from 6% to 10.5%. And in fact, the rise in the from 4.2 to 4.3. And the issue obviously there is that, with AI, either you're augmented or you're basically replaced. And, if I think about my business or like a lawyer's business or doctors, basically like young people are coming for the knowledge. And that's exactly what's being replaced. And so the jobs that used to allow them to step into the labor market are basically replaced by AI. And
so it's so interesting. So she just thinks the Fed, first of all, looking at some of the wrong data, but this idea of knowledge, it's what she describes as a bloodbath, a lost generation of jobs, but also going after not just young people, anybody with knowledge jobs. And I feel like she thinks this AI freight train's coming sooner rather than later, has big market implications. By the way, you can hear that full interview on the Market House Substack, and we put a link in the description as well for Juliet's having a special offer right now. You can check that out. But Darius, you've talked a lot about this K-shaped economy and the importance of that. And I feel like that her comment on the labor market really dovetails to what you were just talking about, and maybe what some in Washington are trying to address.
Yeah, 100%. And I'm a huge fan of Juliet. She's obviously very brilliant. We need more women in finance and investing. So great. Thanks for having her on, and appreciate what you're doing, Maggie. So a couple things on this. One, the irony of this is that the Fed is the one who maintains that data set. It's from the New York Fed in terms of the youth unemployment. Number two, I have personal experience with this. I co-head the Yale football mentorship program, and the general level of anxiety amongst this cohort of young people, Yale football players, people who used to get handed $500,000 jobs coming out of college prior to the GFC. Like, think about it. Those people are having economic anxiety. Imagine what that must be like for most of the country. Mm-hmm. And so, there's very clearly this sort of this we keep calling it politicization of the Fed, erosion of Fed independence, but the reality is it's coming from somewhere. There are so many people on the bottom of that K that are looking around, desperately flailing for answers. And one of the answers is, let's try to boom the economy with fiscal policy. Another answer is, let's get the Fed on board with booming the economy so we can fix some of this stuff. I'm not saying it's right or wrong. I'm just saying you cannot dismiss it as being quote unquote political. We're in a fourth turning regime. Every institution in America, including the Federal Reserve, which, by the way, was made up in 1913, is part of this discussion. They're not immune to the political whims of the country right now, especially in a time with so much income and wealth inequality and so much, just general level discontent, societal discontent.
Yeah. And if you follow that thread down, it ends in protests, maybe in violence other times. I mean, there is a something, very serious here that I think has to be addressed. And I think it's a much smarter way to frame that conversation. So let's talk a little bit about markets on the back of this. Do you think we will continue to see bond yields move lower in lockstep with the Fed? Or, do we have an issue here where the bond market will have its own ideas about where yields should go?
Yeah. So if the promise of AI, which is to, at the bare minimum, stop companies from having to expand with headcount to grow, if that is the ultimate promise of AI and what's, being increasingly priced in asset markets on a trend basis, then yeah, I mean, it ultimately means that, you're talking about an economy where the labor share of national income is going to fall off the bottom of the chart. Right now, it's down at about 52%. It averaged about 57, 58% prior to the dot-com, prior to 2000, prior to China joining the WTO in 2000. And so you think about that swing's about, basically 14, 15% per annum in lost household income for the median worker. You're talking about going from losing 14, 15% to losing 20 to 30% on a per capita basis. If AI is correct. If not, I mean, it could just keep going. And so the reality is we're going to get political solutions to these problems. Now, not all the proposed solutions will work. I have no idea which of the solutions will work, but it's my job as an investor is to help thousands of investors around the world appropriately position for the proposed solutions, what their likely outcomes are, and ultimately how they're going to impact the economy and asset markets. And I think we've been doing a fantastic job of that, if I do say so myself.
Yeah. Is this a situation where run it hot and that money is just going to find its way into assets? It seems hard to fight stocks from here. We see a little pullback today, but is that the result of this kind of attempt to address some of these sort of imbalances?
Yeah, 100%. I mean, it's actually, so I think the part of the reason there's such a level of a sense of urgency, if you will, a level of alacrity down in DC, particularly amongst the members of the Trump administration, to run it hot to try to boom the economy, I think there's a political motivation for that as well, but there's also an economic motivation that has nothing to do with politics. Again, the US government is now gobbling up 40% of the world's capital at the margins every time it goes to the market every month, every year, every quarter. And that number is likely to continue rising at a time, by the way, we have our three largest foreign creditors from a net international investment surplus perspective. Europe remilitarizing, that's an enormous capital call for them to capitalize their own bond markets instead of ours. You have Japan normalizing monetary policy. The one thing nobody ever talks about is the fact that Japan has durably escaped deflation and has a policy rate at 50 basis points. That's wrong. And number three, rather, China and the US are obviously now actively strategically decoupling with each other. And so that reduces China's demand for accumulating FX reserves that are denominated in dollars. Those are three big mega forces that are combining with AI that could potentially push down the level of total employment, or certainly push up the level of unemployment. That all essentially means that you need to find solutions to this from a treasury bond market capitalization perspective. And so I think, to me, it just always winds up in the same place, which is these are massive problems. And the only institution in the world with the balance sheet large and flexible enough to sort of even pretend to address these is the Federal Reserve. This is why the Federal Reserve will get dragged kicking and screaming into, pretending to solve these problems. And again, I'm not saying they will solve them. I'm just saying it's way too early as investors to assume that they're not going to try.
Yeah, I think Braden put it very simply. Powell going to chase yields all the way to the floor because they're going to be forced to.
I don't see that's the problem. So if they do it poorly in a way that scares the market from in terms of spooking our international investment creditor economies, again, we have a net international investment deficit of $25 trillion, almost 90% of our GDP. You can't do it in a way that says, well, 3% inflation is the new number and it might be going to 4%. You can't do it in a way that says the fiscal authority is the only thing that matters to monetary policy, so we're going to take the rate to zero. You can't do it in ways that inflate term premium in the bond market. So what it ultimately means is that they have to be thoughtful and credible about presenting the kinds of economic arguments that I've been presenting for the past 20 minutes in terms of, trying to get the rest of the FOMC and the rest of the financial market participants on board with, hey, these are the things that have to happen. If we continue to gobble up 40% of the world's capital on its way to 50, or 225% of US capital on its way to 300, there will be no small business creation. There will be no, home ownership amongst millennials and Gen Zs. There will be no, anything that could happen from a distribution, anything positive from a distributional perspective. We're just going to be left with an economy where Mark Zuckerberg and Elon Musk have all the AI making all the money, and we're all sitting here with our tin cups out. That's not an acceptable political solution. So we have to understand that where the economy and asset markets are headed through the lens of monetary and fiscal policy.
Yeah, I think this is really important to bring time frame in here, because I think that you are rightly laying out this slightly longer lens on what has to happen to address this. And then there's sort of a short term. So in the stock market, I see this in the short term. Do you worry about a correction here, or does it look like we're going to be in this kind of straight line higher? Because eventually that runs into, you're going to maybe take away from capital, give to labor, take away from some of the sort of maybe higher taxes come in on corporates. Longer term, I see some issues, but short term, is this a straight line higher, or do we get some corrections here?
I've been doing this for a long time, and I've never seen a straight line market go anywhere in a straight line. So
Right.
It's unlikely to be a straight line. But we've been coaching our global investor community that, hey, the path to realize what we've been calling everything we've been talking about, this sort of policy mix that essentially is, some would say run the economy hot, but in my opinion, I don't think it's necessarily running the economy hot. I just think it's addressing the distributional aspects of the economy. To me, that's what's happening here. Is we've got the policymakers in DC are increasingly focusing on GDP and aggregate statistics. They're now starting to focus on distributional statistics, and that transition, which is partially political but partially economic, that transition will cause a confluence of policy choices. And so that confluence of policy choices, pricing in this pro markets confluence of policy choices is not going to be linear. Could we have a correction on a short to medium term time horizon? Yeah, sure. Why not? I mean, this is, to me, you shouldn't, as an investor, live in fear of the next correction. What you should live in fear of is the next crash. And we're essentially arguing that there's a low probability of a crash over a, let's call it, 1 year forward time horizon. Maybe a year forward from today, the probability of achieving a crash over a 1 year forward from that perspective, so a 1 year forward basis, it's probably going to be much higher, but it'll probably from a much higher level of prices and valuations and a much more full level in the positioning cycle. In our view, we're not there yet. So we would say buy the dip until you hear Darius Dale say we're not going to be in paradigm C anymore.
We have a question from Braden asking about the dollar, saying it sort of seemed to like the 25 basis points today. What do you think about the direction in the short to medium term?
If you're a retail investor, what are you doing trading short to medium term risk? This is what people get paid millions of dollars to do on the global buy side. If no one's paying you millions of dollars to trade your account, then stop doing it. Your goal as an investor, as a retail investor, should be to retire on time and comfortably. You don't need to know where the dollar is going over the next 2 to 3 weeks to retire on time and comfortably. You need to expose yourself to productivity growth and outrun financial repression and monetary debasement, and also preventing significant left tail risk in your portfolio. That's what you need to be focused on. So reorient your thought process on those things as opposed to, overreacting to short-term, noise.
Yeah. Is partly sort of outrunning that fiscal repression? Is that, being properly diversified, Darius? And have you changed the way you're thinking about that? I think last time we talked, you're always talking about a KISS portfolio. How are you thinking about that now? And I ask because, gold has come up a lot for people, but we've seen that at record high after record high. That's been kind of a straight line up recently. And so I know we get a lot of questions. If I'm in it, do I stay in it? If I haven't been in it, is that still a reasonable place to diversify and try to protect myself?
Yeah, that's a great question. So you asked two questions. So the first one is, have we thought about portfolio construction differently? I would say yes, you have to think about portfolio construction differently. And we have been doing that for almost 3 years now. When we introduced our KISS portfolio construction process back then, now we branded it to KISS Model Portfolio. One of the things we said was, hey, 60-40, as we know it, the conditions that created the outperformance and the durability of the 60-40 portfolio no longer exist. And so you have to consider, you must add alternatives to your portfolio. Our choice of the alternative was Bitcoin. And even going back to last fall, we said, okay, even this 30% of core fixed income is no longer acceptable for us. We need to just get rid of it altogether and replace it with gold, because ultimately what we recognized based on our extensive research, again, I pump out personally hundreds of slides of research to our clients around the world every week, every single week. And so based on that research, we said, hey, we don't think that the real key risk in financial markets anymore is deflation. The real key risks in financial markets now are financial repression and monetary debasement. And you need to have better hedges than treasury bonds in your portfolio from a portfolio construction perspective to offset that, to outrun that. If again, your goal is to retire on time and comfortably, or help your clients retire on time and comfortably. So that's one. That's the first part of your question. The second part of your question is on gold. And I'll broaden this out to not just gold, but any asset class that's at an all-time high and making new all-time highs on a successive or trending basis. The reality is, this is how you get paid as an investor. Like, you should not be afraid of all-time highs. You should not be afraid of bull markets. What you should be afraid of are two things: not participating, because that means everyone else is getting rich except for you. So when you go to buy goods and services in the future, you're going to have less money than them, which means you're not going to be able to keep up with the inflation rate in the future. So that's step one. But also number two, you have to make sure that you're not suffering significant left tail risks in your portfolio and suffering volatility drag associated with that. I guarantee you some large percentage of the investors listening to me talk right now have no idea what volatility drag means. This just flew right over the head. But to me, that's one of the most important things in all global financial markets. And so unless you are partnered with somebody that can help you maximize upside capture in bull markets and minimize downside capture in bear markets, which is what I've been preaching for years throughout my career, then you're going to struggle, especially as the slope of the returns and the frequency of the drawdowns continues to increase.
Yeah,
so that's what KISS and Dr. Mo do for our thousands of clients around the world.
Yeah, we've talked about that. This is not straightforward. I mean, there was a time when, people felt comfortable just doing that 60-40 or just putting it in a broad equity and forgetting about it for a while. And that did work when we had zero interest rates. Like, there was a time when you could set and forget, but it's a lot more complicated now. Speaking of that, no one knows thyself posting a very nice message. I'm a subscriber to 42 Macro, and I can't tell you how many times that I've said that it's really great research service, and it has been a game changer for my portfolio. Thank you for that nice testimonial. But yeah, you do. And by the way, part of these conversations is to help you have smarter conversations if you are working with somebody, or if you're looking for someone, or if you're trying to figure out the right person for you, is to be able to have a really intelligent conversation. Because it's hard sometimes, if you haven't been plugged in, it's never too late. You can plug in and make sure the person who's working for you is working for your money and not just dialing it in,
And I'll say this, investors are by and large really smart people. Like we survey our client base, like they're all rich people who own successful businesses. That's generally what an investor is someone who has money to invest. And usually you don't get money to invest unless your parents figured it out and gave it to you. Most people in this country, thank God we still have a capitalist society. Most people in this country have to work hard and earn money, and they wind up having money to invest usually about around the time they start having gray hair. And so what we find in our surveying our client base is that these are just really, really smart people who don't know this stuff, this particular thing. In the same way that if I went and tried to run a manufacturing plant, I would know nothing. And so you have to assume that you can't assume as someone sitting in my seat, and this is me talking to the other people in our industry, you can't assume that you know everything and that these people don't know anything. That's not how this works. Why we have such a wonderful partnership with our customers, and I think we have, what was it, 3.2% attrition rate, which is only a third of the Apple iPhone, by the way. We have a third of the attrition rate of the Apple iPhone. And I think the reason for that is because we understand that these are really smart people, and we just partner with them and meet their needs where they are, as opposed to talking down to them or forcing them to take all this kind of risk that they're not comfortable with. We just give them the tools to take the risk that they want.
Yeah, you work too hard for the money. We don't want anyone giving it away. Mark Z asking, what's your outlook on small caps in the energy sector? Very specific, but I will say we've been getting a lot of comments about small caps and questions about small caps lately, especially if we are on an easing cycle.
Yeah, so if you're a retail investor, earmuffs, because there's no reason you need to be taking factor risk. If you learn one thing from me before I get hit by a bus, is that as a retail investor, you have no reason to take factor risk. You can participate in the broad beta of the market without having to make any difficult decisions that tend to cause most investors to have negative tracking error. Most people have negative tracking error when they take factor bets, including institutional investors, by the way. So people are getting paid millions of dollars a year to take factor risks or struggling with it. I got to imagine that you're probably going to struggle with it as well to greater quantities. So assuming this is probably a professional investor asking this question, the probability, if we're right, if we continue to be right on our paradigm C theme, which we authored back in April, then it's very likely that as the economy strengthens from the dual tailwind of fiscal monetary easing, that's going to kick into very high gear in the first half of next year. It's very likely that we see a broadening out in equity market participation. Right now, the market is heavily concentrated in things that investors have high degree of confidence in from a cash flow perspective. That level of confidence will start to broaden out amongst other sectors and factors in the market, because the economy will start to get better. And not only will it get better, it's highly likely to surprise to the upside on a durable basis, just given the term structure of GDP estimates, the term structure of earnings estimates. They're all still too low in our opinion. And so it's very likely we see a broadening out trade in 2026. So if you're a professional investor, I think you can take that to the bank. And I think, and when I talk to our institutional clients throughout the week, everyone seems to agree with that. So I don't think I'm making news here. But if you're a retail investor, why do you need to be long small caps versus large caps? Why can't you just be long the market?
Yeah.
And go back to the beach.
Yeah, great point. Even if you have to get on a plane to do that, which we'll see here, although it's still pretty warm. Is there anything we have to think about sector wise here, Darius, if we are on the beginning of an easing cycle? I know we have people also talking about home builders, banks, like if this environment favors certain sectors.
Yeah, we've been pounding the table along financials since early May. Financials is if we're right on paradigm C, one of the levers that the administration are likely to pull to facilitate these, very positive pro-economy, pro-markets outcomes is financial sector deregulation. Financial sector deregulation obviously touches every industry in the economy, but it's definitely going to touch the financial sector in terms of improving the profitability outlooks for those companies. So I don't think if you have to pick sectors, and this is typically the typical investment advisor, they're charging their 175 basis point to 1% fee. So they got to look like they're doing something, which in my opinion, I think the number one thing you can do for your clients is to help them maximize upside capture, not, overlay your thoughts about what sectors and factors are going to work. But if you insist on doing that as an investment advisor, then in our view that financials will outperform over long-term time horizon, and housing stocks will continue to outperform over long-term time horizon. I think we nailed the absolute bottom of this market cycle in the housing stocks, and so that's been a good trade for us, for our clients.
If you are going with the broader market, do you have to buy into tech doing well? I mean, every time someone tries to argue that the leadership is going to shift or there's going to be a great rotation, we just see that sort of AI play still dominating. I mean, you just think back the past month, Oracle, there have been some huge gains in these stocks. Do you have to accept that concept if you're just going to be long the U.S. equity market?
Yeah, and yes, the answer is yes, and for a couple of reasons. One, fundamentally, like growth comes from productivity growth, and productivity growth comes from new technology and the development and the advent and the proliferation of new technology. So, it's what we call tech today in terms of software and AI. They would have called combustible engines and robo tech back then. You know what I mean? So it's all the new, whatever's new, and that's where the productivity growth comes from. So yes, but from a more of a market structure standpoint, I cite the research of folks like Mike Green over at Simplify in terms of the passive flows and how there's sort of inelastic demand essentially for these very large companies as a function of these passive flows. So if you're in a bull market, you have to assume that the largest companies, the largest sectors will generally outperform because they have structural demand tailwinds relative to smaller companies and smaller sectors. Now, that doesn't mean it has to happen on any sort of trailing look back period, 1 year, 1 month, 3 months, who cares? The reality is on a long-term time horizon, that's highly likely to be true until the market structure changes.
Until it changes, and that's the narrative that we have to keep an eye on. But we certainly have seen that be the case. Darius, it's always fantastic to catch up with you. I so enjoy our conversations, and as I said to you before, I always love your ability to comment on what's going on in our world. You're always putting such great vibes and great advice out for people, so we appreciate that.
Maggie, you're the best too. I'm very grateful that God has blessed me with the platform that we've been able to develop, and the wonderful people that are in this on this journey with me. We have thousands of people around the world in our global investor community, and I think there's a common thread outside of just trying to generally do well for their families. I think there's a real underlying common thread of these are people who care about the world and want to see good outcomes for the world, and that's certainly something that I wake up thinking about and go to bed thinking about, and I know you share that sentiment as well. So. We're not going to lose the fight easy. Us good folks, we're not going to lose easy. So I appreciate you, Maggie.
I love it. I love it. And as usual, you're getting a lot of love for your fashion and your tie. People, they're all telling us we're halfway to St. Patrick's Day.
No. We're frogs being boiled alive in a pot of monetary debasement and financial repression. The sooner you realize that, the better you will create better, more positive financial outcomes for you and your family.
I'm trying to climb out of that pot. I'm doing my best to climb out of that pot. I think we all are. Darius, thank you so much. Thanks to all of you for such a fun chat today and all the great questions. As always, we will see you again on Friday. We have Coach Dale in for his Friday residency, so we'll talk all about what he's seen in the chart. So thanks so much. Thanks, Darius.
Thanks, Maggie.
As always, good luck. Take care out there.